Hello world, welcome to Farm the Market. I was doing numbers during the weekend and I found out something very interesting that I thought it would be nice to share with you. I hope you enjoy it. It's basically related to what happens when the S&P 500 has a 10% swing down or more, and what happens to some volatility metrics when those events occur. So, as I said, I usually track whenever the S&P 500 has at least a 10% drop. And as of September 15 of this year, there had been 23 events of such drops, counting since 2007. Here you can see a breakdown of how many have happened each year. And well, of course, there's no surprise that 2008 and 2020 have the most events, but 2022 is getting there. Just to be on the same page, what do I mean by a 10% swing down? Well, it's pretty obvious, but I wanted to share an example with you. Basically, I mean whenever we have a high and the S&P 500 on a daily close drops more than 10%. So I use this period from February to March 2020 because there are many examples that we can use. And as you can see here, there were 1, 2, 3, 4, 5 events in a very short period of time. And whenever we have a new high above the last drop, that's when I count again. And so, well, this is what I mean by swings down. And this is important because this is what I'm going to be referring during the whole video, okay? Whenever I talk about these intervals of time, what I mean is these periods when the S&P 500 drops at least 10%. So I also mentioned at the beginning that I track a lot of figures, and one of the things I track is what happens with the VIX Futures Curve when these events happen. And well, again, as of September 15, in all of the 23 cases that had occurred, every time that the 10% threshold was broken, the VIX structure for the VIX futures curve was in backwardation. So at the close of that day, every time, for 23 times in a row, the VIX curve was always in backwardation. So I have been tracking this for many years. So basically it was just something that, I drag the formula on my Excel spreadsheet, and every time it's the same result. So it was something that I was aware of, but really never paid too much attention to. Just a quick parenthesis, what do I mean by backwardation in case you're new to the channel or haven't heard that term before? Well, basically when you have the VIX futures curve, what I consider backwardation is when the first month or the front month is above the second month, okay? So there is a pretty simplified graph here, but that's the idea. Whenever the first month is above the second month, that's how I measure it, and that's what I consider backwardation in the VIX curve. And that's mainly what everybody considers the curve to be in backwardation. Some of the other nodes might be above or below, but the front 2 months are the main reference because at the end of the day, it's a short-term volatility that most people pay attention to, and that's usually what's affecting the market the most. So what happened? Well, last Friday on September 16th, we had a daily close that got into the list. The S&P 500 index dropped, but barely, but more than 10%. So it went into this list that I track. And when I was updating the numbers, I was surprised to notice that this new entry into the list had a surprise for me. And in this case, as you might imagine, because of the title of this video, well, the thing is that the VIX future curve didn't really notice. I mean, there was a 10% drop on the S&P, and the VIX curve remained in contango. So This caught my attention because, as I said, this has never happened before in the last 15 years, and I think it's relevant. As I have mentioned before, there's no single metric or indicator or anything of that sort that might tell you the whole story or that might tell you what the market will do next. But I thought this was interesting, so I decided to make this video about it. What's so interesting about it? Well, I think the market pretty much is in a situation where they think a 10% drop in the S&P is fine. It's just nothing to worry about. And I think that's not, that's giving maybe some people a false sense of comfort because it's a big deal, a 10% drop in the S&P 500. So I think the market, as we will see in a few slides uh, ahead, this is not unusual behavior in terms of the market getting used to what is going on. After all, the huge volatility spikes percentage-wise happens when no one sees them coming. So that's just human nature, that's just natural. When things are pretty calm and something happens, that's when volatility really spikes, again in a percentage term basis, in a really big way. So since the whole of 2022 has been, on a downtrend, it's in a sense it's normal for the markets to be not so surprised to see a 10% drop, but at the same time, I think you cannot underestimate a 10% drop. I guess that's one of the part of the idea that I'm trying to convey here. One might say, well, okay, 2022 has seen a few drawdowns, but you cannot compare it with 2020, for example. If we go back to the last huge drop in the market, because back then the time window was very small, so it was natural that the spikes will increase the volatility because it was in a very short period of time. But that might be what we have fresh in our minds, and that's what I thought at first. Actually, that's why I'm bringing this up, because I thought, well, the last time we were in a bear market, it was so fast, it was such a V-shaped recovery that in a short period of time, it was natural for volatility to spike, and for the market be, let's say, more aware of what was going on. But even if we consider this period of time that was pretty unusual, if we go back again to the sample of 15 years and 24 occurrences for this event, we will see that it's not usually so short-lived, the drops in the S&P 500. Actually, on average, they take almost 1 month. All these days are counted as calendar days, not trading days. So it usually takes around 1 month for the drop to occur. We have a max value of almost 3 months, and of course we have a very short period of time also in 2020 of only 2 days. But even so, even with these extremes, we can see that the last swing that took 31 days is pretty much in the average. So I don't think that explains it. I just think the market's getting more complacent, and it's just like the dog in the meme. It's just sitting there saying, well, this is fine, and I think it's something to take notice about. Again, just breaking down the swings during this past year, we can see that they have been long-lived, not short-lived like in 2020. So that's not really a factor, I think. Well, what does this mean? I think that most people out there follow just the VIX, the famous fear index or whatever you want to call it. I have said in several occasions, I don't think the VIX by itself it's a good metric, but since it's followed by a lot of people, I thought I will put this idea in context of what's going on with the VIX. Right now, well, not right now, but as of September 16, the VIX closed at 26.25. So if we compare it to the levels that it has reached during 2022, we could say that it's quote unquote a low VIX. And this could give people a false sense of security because even though the market has adjusted, we are not even close to 30 or 35 that are thresholds that people usually follow, and as we can see in 2022, those levels have been relevant. So what I'm trying to say here is don't be fooled by the current level of the VIX. The fact that it's under 30 means really nothing. I mean, it's really not telling us that the risk is not there. So just keep that in mind. I also gathered some data from what I tracked, and I wanted to share it with you. Once again, putting it in terms of what happens with the VIX in terms of percentage changes during these time windows where the S&P falls at least 10%. So I'm comparing the global financial crisis because I think that's a more comparable pair. That it's better to compare that time window because, as I said, 2020 was quite particular. So if we look at some periods during 2008 and 2009, where the S&P 500 dropped again, sorry to be so repetitive, but I'm always talking about these periods where the S&P drops 10% or more. If we compare that with 2022, we can see that the general idea basically remains. The first time it happens, we are surprised, so to speak. The market is, caught off guard, and in percentage terms, the spike in the VIX is always higher. And as time goes by, these spikes in the VIX will go lower and lower, or well, at least they tend to be smaller, because the market is getting used to the new situation. That doesn't mean, as you can see, that the moves in the S&P cannot be huge, because we're still talking about moves that oscillate between 10 and 14%. And even though the VIX is not moving that much in percentage terms, your portfolio, that I assume is generally highly correlated to the S&P, will be still moving by more than 10% during this period. So that's something to keep in mind. So just to bring the idea back home, so to speak, it's something to notice that the VIX term structure didn't switch to backwardation this past Friday. I think it's relevant, and it's something that doesn't happen, well, as we just watched. It doesn't happen, well, at least it hasn't happened for the past 15 years. So I guess what I'm trying to say is that don't be complacent. Don't be, how should I put it? Don't think the worst is behind us already, because if this isn't even turning when the S&P 500 drops 10%, that's telling us that maybe we have worse surprises in the horizon. So instead of being calm like the dog that I showed you earlier, that is just saying that everything is fine, maybe this is a hyperbole. I'm not I'm not trying to scare you or anything, but at least be aware that things are not all right. Okay, be tactical, be mindful. Keep always a check on risk and what you're exposing your portfolio to. And well, that's basically the idea. I hope you found this presentation interesting. And well, in case you stayed all the way to the end, thank you very much. And please remember to like, subscribe, and all that. So thank you very much. Have a good one.